Preparing for FP&A Analyst at AES interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A contribute to a company like AES? FP&A connects AES's operational activity to financial decisions. I would help build budgets, update forecasts, explain variances, and provide leaders with clear analysis on earnings, cash flow, capital spending, and project returns. In an energy business, that means understanding drivers such as generation, availability, power prices, fuel costs, customer demand, and construction timing. The role is not simply reporting historical results. It helps management allocate capital, manage risks, and make informed growth decisions. While answering, focus on planning, forecasting, performance analysis, decision support, business partnering, capital allocation, and translating operational drivers into financial outcomes across utilities, renewables, storage, and other energy businesses. Question 2. Why do you want to work in FP&A at AES? I am attracted to AES because the company combines a complex operating environment with a clear role in the energy transition. FP&A would let me apply financial analysis to tangible drivers such as renewable development, storage, customer demand, and power market exposure. I also like that the work is cross-functional. Strong analysis requires conversations with operations, commercial teams, accounting, and project leaders. I would bring disciplined modeling, curiosity, and a practical communication style. Make sure to cover genuine motivation, AES's energy transition platform, the combination of finance and operations, interest in renewable projects, analytical development, and how your experience supports reliable decision-making. Question 3. Walk me through how you would build an annual budget for an AES business unit. I would begin with historical actuals and identify the main operating drivers for the business unit. For AES, those could include generation, contracted volumes, pricing, fuel, availability, headcount, maintenance, and project milestones. I would collect assumptions from operating and commercial teams, build the income statement, balance sheet, and cash flow, then test sensitivities and downside cases. After review with leadership, I would document assumptions, resolve inconsistencies, obtain approval, and establish monthly variance ownership. In your answer, talk about historical baselines, operational drivers, assumptions, stakeholder inputs, project schedules, scenario analysis, review cycles, approvals, documentation, and alignment between income statement, balance sheet, and cash flow. Question 4. How would you forecast revenue for a renewable energy asset? I would separate contracted revenue from merchant or market-based revenue. Contracted revenue would reflect expected production, contracted price, availability, and any contractual escalators. Merchant revenue would require generation forecasts, capacity factors, seasonality, degradation, curtailment, and forward power price assumptions. I would also consider ancillary or capacity revenues where relevant. Finally, I would compare forecast generation with historical performance and create sensitivities for weather, outages, pricing, and delays so management understands the range of outcomes. Be sure to mention contracted versus merchant revenue, generation assumptions, capacity factors, degradation, pricing, curtailment, availability, ancillary revenues, seasonality, and sensitivity analysis around weather and market conditions. Question 5. What is the difference between a budget, forecast, and long-range plan? A budget is the approved financial plan for a defined period and usually becomes the primary performance benchmark. A forecast is management's latest expectation based on actual results, updated assumptions, and known changes. It may be refreshed monthly or quarterly. A long-range plan looks several years ahead and connects strategy, capital deployment, growth, financing, and returns. At AES, I would use the budget for accountability, the forecast for decisions, and the long-range plan for strategic direction. While answering, distinguish fixed annual targets, rolling expectations, and strategic multi-year planning. Explain update frequency, purpose, ownership, assumptions, and how each supports performance management at AES. Question 6. How would you analyze a monthly budget versus actual variance? I would first identify material variances by account, business unit, and driver, then distinguish timing items from true changes in expected performance. For revenue, I might analyze volume, price, availability, and mix. For costs, I would examine rates, usage, headcount, and project timing. I would validate explanations with business owners, assess whether the variance affects the full-year forecast, and summarize the cause, financial impact, outlook, and recommended action for management. Make sure to cover materiality, timing versus permanent differences, price-volume mix analysis, operational and accounting causes, business owner discussions, forecast implications, and concise communication of actions. Question 7. What financial and operating KPIs would you monitor at AES? I would tailor KPIs to each business, but core measures could include revenue, adjusted EBITDA, operating cash flow, free cash flow, CapEx, leverage, and return on invested capital. Operating indicators might include generation, capacity factor, availability, outage rates, contracted coverage, customer demand, project progress, and cost per megawatt hour. I would also include safety and reliability metrics because financial performance is sustainable only when operations are safe, compliant, and dependable. In your answer, talk about EBITDA, operating cash flow, CapEx, free cash flow, generation, availability, capacity factor, contracted coverage, customer metrics, project milestones, safety, and KPI relevance by business model. Question 8. How would you model the impact of a change in power prices? I would first map which volumes are contracted, hedged, or exposed to merchant prices, because the same market move will not affect every asset equally. I would apply the price change to exposed generation, consider basis differences, pass-through clauses, hedge settlements, and timing, then flow the result through revenue, EBITDA, taxes, cash flow, and valuation where appropriate. I would present a sensitivity table showing outcomes under several price scenarios rather than relying on one point estimate. Be sure to mention contracted and merchant exposure, volume assumptions, hedges, pass-through mechanisms, basis risk, timing, EBITDA and cash flow effects, and scenario or sensitivity tables. Question 9. How do you distinguish a timing variance from a true performance variance? I would trace the variance to the underlying activity and expected timing. A delayed maintenance invoice, construction milestone, or customer receipt may create a temporary variance that reverses later, while lower generation, higher labor rates, or lost volume may represent a permanent change. I would compare actuals with schedules, purchase orders, operational reports, and prior forecasts, then confirm with the owner. The key is updating the forecast appropriately rather than treating every variance as a trend. While answering, explain comparing actual activity with schedules, purchase orders, accruals, production data, and prior forecasts. Discuss reversals, permanence, forecast updates, and documentation. Question 10. Describe a financial model you would build for an energy project. I would build the model around construction, operations, financing, and exit or terminal assumptions. Construction inputs would include development spend, schedule, contingency, and capitalized costs. Operating assumptions would cover capacity, generation, degradation, pricing, contracts, operating expenses, taxes, working capital, and maintenance CapEx. I would calculate project cash flows, debt service, equity contributions, IRR, NPV, and coverage ratios, then test sensitivities for delays, cost overruns, production, pricing, and financing terms. Make sure to cover construction assumptions, operating period, generation, pricing, operating costs, tax, financing, depreciation, cash flow, returns, sensitivities, and model controls. Question 11. How would you evaluate whether a capital project is financially attractive? I would assess the project's risk-adjusted cash flows rather than relying on a single return metric. The analysis would include NPV using an appropriate discount rate, IRR, payback, cash flow timing, leverage, coverage ratios, and downside cases. I would review contract quality, counterparty risk, construction assumptions, permitting, interconnection, and operational reliability. Finally, I would compare the project with AES's hurdle rates, strategic priorities, and competing uses of capital before recommending approval. In your answer, discuss NPV, IRR, payback, weighted average cost of capital, risk-adjusted scenarios, strategic value, contract quality, financing, execution risk, and comparison with alternative investments. Question 12. What is working capital, and how would you forecast it for AES? Working capital represents operating assets and liabilities that affect cash conversion, including receivables, payables, inventory, deposits, and contract-related balances. I would forecast each component using operational drivers, such as billed revenue and collection days for receivables, procurement patterns and payment terms for payables, and fuel or spare parts requirements for inventory. I would incorporate seasonality and unusual settlements, then link the schedule to cash flow so management can anticipate liquidity needs. Be sure to mention receivables, payables, inventory, deposits, contract assets, seasonality, collection patterns, supplier terms, operational drivers, and the effect on cash flow and liquidity. Question 13. How would you forecast cash flow for an AES business? I would begin with operating earnings and convert them to cash by adjusting for non-cash items and working capital movements. Then I would layer in maintenance and growth CapEx, taxes, interest, debt maturities, financing proceeds, distributions, and other investing or financing activity. For project businesses, I would model construction timing and restricted cash separately. I would reconcile beginning and ending cash to the balance sheet and include downside scenarios for price, production, collections, and delays. While answering, cover operating cash flow, working capital, maintenance and growth CapEx, taxes, debt service, financing, distributions, liquidity, restricted cash, and reconciliation to balance sheet movements. Question 14. How do depreciation and amortization affect FP&A analysis? Depreciation and amortization reduce EBIT and net income but do not directly reduce current period cash, so I would separate their effect from operating cash generation. The expense still matters because it affects earnings, taxes, asset values, covenant metrics, and return analysis. I would model it based on asset classes, useful lives, and placed in service dates, especially when projects enter operation at different times. I would then explain the distinction between EBITDA, EBIT, net income, and cash flow. Make sure to cover non-cash expense, asset lives, placed in service timing, EBITDA versus EBIT, taxes, free cash flow, CapEx planning, and differences between accounting and economic performance. Question 15. How would you partner with accounting during the monthly close? I would align with accounting on the close calendar, required inputs, accruals, reclasses, and reporting deadlines. My role would be to provide operational estimates, validate unusual movements, review whether actuals align with forecast assumptions, and investigate discrepancies without duplicating accounting's responsibilities. I would document material judgments and escalate policy questions appropriately. A strong partnership produces accurate actuals quickly, improves the next forecast, and prevents recurring issues from being hidden in unexplained variances. In your answer, talk about close calendars, accruals, reconciliations, journal entry review, actual versus forecast consistency, accounting policy, variance explanations, controls, and respectful issue resolution. Question 16. What would you do if an operating manager challenged your forecast? I would first understand which assumption the manager disagrees with and why their operational knowledge suggests a different outcome. I would compare both views with historical data, current operating evidence, contracts, schedules, and external information. If uncertainty remains, I would model both cases and make the risk explicit rather than forcing false precision. I would aim for an agreed base case, document ownership of assumptions, and escalate only when the disagreement materially affects management decisions. Be sure to mention listening first, clarifying assumptions, using objective data, separating facts from judgment, testing alternatives, preserving accountability, and escalating only after collaborative resolution efforts. Question 17. How would you present a disappointing forecast to senior leadership? I would lead with the headline, what changed, the quantified impact, and whether it affects the full-year outlook. Then I would separate root causes, such as production, pricing, costs, timing, or execution, and distinguish controllable from external factors. I would present the base case, downside risk, and specific mitigation actions with owners and dates. Senior leaders need transparency and options, so I would avoid burying the issue in detail or presenting unsupported optimism. While answering, focus on concise messaging, quantified impact, root causes, controllable versus external factors, updated outlook, mitigation actions, scenarios, and avoiding surprises or excessive technical detail. Question 18. How would you use Excel or financial systems in an FP&A role? I would use Excel for flexible analysis, including structured assumptions, linked schedules, pivot tables, sensitivity tables, and clear checks. I would use the ERP or planning system as the controlled source for actuals, budgets, and approved submissions, then reconcile extracted data before modeling. I value consistent file architecture, version control, documented inputs, and error checks. Where possible, I would automate repetitive processes, but I would always retain reviewable logic and a clear audit trail. Make sure to cover structured models, linked assumptions, formulas, pivots, reconciliations, scenario tools, data integrity, ERP or planning system inputs, automation, version control, and reviewability. Question 19. What controls would you apply to an FP&A reporting process? I would establish controls around data sources, access, approvals, reconciliations, model changes, and reporting sign-off. Before publishing results, I would check that totals agree with the general ledger or approved planning system, investigate unusual movements, validate formulas, and confirm that assumptions are current. I would maintain version control and a change log, separate preparer and reviewer responsibilities where practical, and document recurring procedures. Good controls protect accuracy while keeping the process efficient. In your answer, discuss source data validation, access controls, reconciliations, approval workflows, version management, reasonableness checks, change logs, segregation of duties, and repeatable documentation. Question 20. How would inflation affect an AES forecast? I would assess inflation by cost category and by contract, rather than applying one blanket rate. Labor, maintenance, equipment, construction, and administrative costs may respond differently, while revenue contracts may include escalators or pass-through provisions. I would also consider the effect on interest rates, financing costs, project budgets, and real versus nominal returns. The forecast would include a base case and sensitivities for higher inflation, with clear identification of which exposures are hedged or contractually protected. Be sure to mention revenue escalators, labor, equipment, maintenance, construction costs, financing, contracts, pass-throughs, real versus nominal analysis, timing, and sensitivity scenarios. Question 21. How would you analyze the financial impact of a project delay? I would identify which milestones moved and translate the delay into a revised construction and operating schedule. The model should capture postponed revenue and operating cash flow, extended development or financing costs, changed CapEx timing, potential penalties, lost incentives, and any impact on tax or debt assumptions. I would recalculate NPV, IRR, liquidity, and covenant metrics, then compare mitigation options such as accelerating procurement, renegotiating contracts, revising financing, or adjusting the commercial plan. While answering, cover delayed revenue, extended development costs, construction interest, CapEx timing, tax credits or incentives, contractual penalties, liquidity, revised returns, and mitigation options. Question 22. How would you assess the impact of an unexpected plant outage? I would quantify the outage duration, affected capacity, expected lost generation, contract obligations, replacement power costs, repair expense, and potential insurance recovery. I would assess whether the event affects only the month or also annual availability, customer commitments, and forecast generation. Then I would update revenue, EBITDA, cash flow, and maintenance timing, with recovery scenarios based on the repair schedule. I would also capture the operational lesson and whether contingency assumptions need strengthening. Make sure to cover lost generation, contract obligations, replacement power, insurance, repair costs, maintenance timing, availability metrics, cash flow, forecast revisions, and scenario-based recovery assumptions. Question 23. Tell me about a time you found an error in financial analysis. In a monthly reporting file, I noticed that one business unit's expense trend did not reconcile with the general ledger. I traced the issue to a duplicated data import after a source system change, confirmed the correct balance with accounting, and rebuilt the affected schedule. I promptly informed my manager, quantified the reporting impact, and corrected the submission before distribution. I then added a control comparing record counts and totals, which prevented the issue from recurring. In your answer, use a clear situation action result structure. Explain how you detected the issue, validated the root cause, corrected it, communicated transparently, and improved the process to prevent recurrence. Question 24. How would you prioritize competing requests from different AES stakeholders? I would rank requests by decision urgency, financial materiality, deadline, and dependency on other work. A request supporting a near-term investment decision or executive forecast would generally take priority over a useful but non-urgent analysis. I would clarify the required output, communicate realistic timing, and provide an interim view if necessary. I would protect quality by using a structured checklist and documenting assumptions, while renegotiating priorities early rather than silently missing commitments. Be sure to mention urgency, decision impact, deadlines, dependencies, data availability, materiality, stakeholder communication, realistic sequencing, and maintaining quality under pressure. Question 25. What questions would you ask us about this AES FP&A role? I would ask which AES businesses and financial metrics this role supports, how often forecasts are refreshed, and which operating drivers create the most uncertainty. I would also ask about the planning and reporting systems, the balance between recurring reporting and ad hoc analysis, and the stakeholders I would partner with most closely. Finally, I would ask how success is measured in the first 6 months and which current FP&A challenge the team most wants this person to solve. While answering, ask about business unit scope, forecasting cadence, key performance drivers, systems, stakeholder interaction, current challenges, success measures, development opportunities, and how FP&A supports AES's strategy. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.